Welcome to episode 2 of Compounding Brothers. How are you, my brother?
How are you? Good. How are you?
You look great in those pics.
Yeah, no, it was it's a little family trip. We went to a wedding in Cusco and took a day trip to Machu Picchu. And as you can see, it was a gorgeous day. And this place is just magical. Yeah, you hear about these type of places and you say, wow, is it really all that it's cracked up to be or what they say it is? And this really was. It was pretty amazing.
You are acting as a good sales agent for the tourism industry of Peru. And as you know, we're planning that trip. So when we get there, you'll have to join us, please.
Absolutely. Be my pleasure.
Claudia and I'm not going to go over all the busy summer that we had with the 4 kids, but I just wanted to, pause a moment to think about when Axel was 2 years old and we were near you when you lived in Greenwich and we were in Larchmont. That's at the bottom. And now we're leaving him for a summer program, his first summer program in business. And he had a blast and the same with the other 3 kids. And after we left him, Claudia and I spent a lovely evening watching the sunset in the South Beach Bay and bring family because family is the most important thing.
That's why we do this.
After that, we spent. I saw you were using the ELT, so I didn't want to be less, and I took a picture with the ELT. We spent a week in Dominican Republic and then came back to Naples and spent a fantastic few days in the Tiburon Ritz-Carlton there, and there the 6 of us, Ilan in the left, Axel, Maya, Lara, my lovely wife and myself, spending some time together.
That sounds like fun.
Yes. So with that, we wanted to stress that all the content that Paul and I share here, having a lot of fun, is only for informational and entertainment purposes, that you need to seek a financial advisor before acting on investments because investments entail financial losses. And everything we do here, sharing ideas with you, is for informational and entertainment purposes, but it's not advice. And we wanted to recap on our 6 mega trend themes. We spent in our prior episode talking about the Technium, and we spent significant time in our WhatsApp channel talking about the 6 themes. We talked about the opportunity that we have within the AI space, playing the arms dealers rather than the warring factions. And we discussed a few ideas that we like in the cheap equipment manufacturers. And Paul and I spent significant time explaining why the voracious appetite that Technium has for energy will only be satisfied in the short term by the natural gas feedstock. And we talked about 2 opportunities that we like in the space. And today, we're going to be talking about a second leg of that opportunity associated with the end game in terms of the energy transition, which is going to be tied to solar and batteries. Paul, in episode 1, we spent time talking about what we saw as a frothy market. And you and I came to read this article by Hassman in Strategic Advisors Weekly Note, where he shows analysis on how egregious valuations have become.
Yeah, John's been doing this for a long time. I started reading his notes back in, as early as 2000, I think. And he probably has the best valuation metrics out there, and it's amazing. This graph just tells you so much. And like we mentioned in episode 1, this is an average. So we went through, as they say, a drunk man passes a sobriety test on average. So that is to say that we have a bifurcated market, and we've got some very inexpensive stuff if you know where to look and where to fish. And at the same time, you've got egregiously valued stocks that are things that we recommend to avoid at all costs. If not, you're not going to weather what is probably going to be some rocky times in the future, where the guys that are going to do well are the guys that are very disciplined and good stock pickers.
Yes, and it's important to highlight that this chart is not the index or it's not the price, it's the market capitalization over the gross value added. And it's at its most extreme valuations in history. And one of the quotes that Hassman brings into the picture is Jeremy Grantham's saying that we are at one of those times in history when you look at 5, 10, 15 years later, you would rather have been in cash than in the market. And one way Hassman illustrates in his article this situation is by showing this scatter plot of valuations against future realized returns. And if you look at the arrow at the bottom right on July 1825, the expected returns on the S&P 500 for the next 12 years was a negative 6% annual rate of return.
Yeah, it's kind of like a PE ratio, right? Where you have the market and the gross value added, which is kind of like the earnings, and it shows how expensive the market is and how that translates into negative future returns. So what this is telling us loud and clear is that the markets, the equity market in general, is very expensive, and unless you know where to put your money, you're probably going to get hurt. So this is a big warning sign.
That's a great point, and I'm going to borrow a word you brought again, which is bifurcated. We're not saying that there are no places where to invest. We're saying that if you blindly follow an index, there's no 12-year return associated with the current instance, meaning the current valuation, because across a century of market cycles, valuations have never been this extreme. As you said, this is a big warning sign.
Yeah, look, as we discussed in episode 1, you have this what's become a perversion of which is passive investing, where it's kind of like if you went to an auction and saw a painting and you and I said, okay, it's $100, and then the next guy says, I'll buy it for $200. Then the guy says, oh, $200, I'll buy it for $300. And that's what's happening with some of these Mag 7 stocks, and this is what passive investing does. And at the opposite end of the spectrum, a stock is getting cheaper and people are just running away from it. So it's become a real perversion with respect to passive investing and what it's doing to a lot of the equities. It's making things more extreme on either side.
Yes.
So that's good for guys like us.
It's very good for guys like us. And it's also important to remember that this is not a market timing tool. If we think in terms of all the CTAs and all the systematic investors who lost money because they sold in the throes of the Liberation Day, April 2nd sell-off, and only later have started to participate, all those people are risking their careers if they don't recover by the end of the year. And all of these people are going to be chasing opportunities, and that's probably why we're seeing this crazy melt up in meme stocks again. And one of the things, and this is the last chart we brought from the Hassman's article, is that we are in one of those kernels of time where you would be better off putting your money in a bond, in a 10-year bond, rather than in equities on an average index. And the point that Hassman is making is that over the last 96-year period, there was 2/3 of the time in history where you would be better off putting your money in bonds. And at this time, it's shocking to think that you will be passing one of those in time.
It shows you human beings never learn.
We learn for a few hours and then we forget and we need to remind it again.
That's
and right. In the last episode, we talked about not only that valuations were elevated on a multiple basis, but also that we were using earnings at a time where margins are at a very cyclically high level. And one of the things that this chart illustrates is that corporate profits and corporate profits as a share of total GDP or national income are at a very high level. And this is a consequence of trade policy and tax policy that not only over the last 2 decades, but over the last 5.5 decades have favored capital at the expense of labor. And many of the things that this administration is doing in terms of protecting or closing the domestic market via tariffs or cracking down on illegal immigration, those are things that are going to create labor inflation. And labor inflation is going to drive inflation, but it's also going to put pressure on profits. And I think today, the fact that we are seeing wages increasing without seeing the impact yet fully of tariffs is another warning sign in terms of equity investment.
Yeah, I think what the president is doing is he's changing the competitive landscape. Before, we've had a landscape where all the margin was accruing to the supplier of capital in a completely open economy where corporations could deploy capital, shop around for the cheapest labor cost in the world, where that may be, and change it over time. And now the president said, okay, we're going to impose tariffs in order to cut that dynamic. And he is the supply chain, if you will, of production is starting to, the labor portion of that supply chain is starting to accrue more competitive advantage through the policies, tariff policies. And that there's only one way that ends up, and that is accruing more of the margin to the worker than it was to the corporation before. So this shouldn't be a surprise to anyone. Margin pressures due to labor costs are going to be something that we'll have for this administration at least. And probably it's a good thing.
I agree. And I find quite hilarious that the liberals are the hawks in terms of monetary policy, and the conservatives are the doves. It's a complete inversion of personalities driven by a political landscape that became completely pure lunacy.
Yes, it definitely is for now to say that the Republicans are the party of the working man, it's something I hadn't heard ever.
Absolutely. Okay. Many of our 6 teams have been playing in the news, and I wanted to talk a little bit about how things are happening, because this piece of news where AWS is counting hundreds in the prior episode we discussed was probably harbinger of pain to come. And look at what the earnings releases are showing up.
Yeah, this was pretty interesting. We discussed in episode 1 how where not to play in the AI race was the hyperscalers and the cloud service providers, where we were seeing an all-out war on rental rates for these NVIDIA 100 chips. And interestingly, when we've seen sort of a tale of two cities, right, where Microsoft had very good results, while Amazon had pretty poor results in their cloud division. Yeah, we know that AWS holds sort of 29% and Microsoft 22% of this cloud services segment, and definitely Microsoft out-earned Amazon in this space in Q2. So they're bridging the gap, but what the next question is, how are they bridging the gap? And they're doing so by spending $30 billion a quarter to do it. So in keeping with the theme we discussed in episode 1, why would you want to get into a gunfight where these two players are duking it out, and it's only going to lead to margin erosion, where we can look at the picks and shovels in the segment and the energy that fuels it. So I think that the theme is starting, what we predicted is starting to play out. And it's interesting that it's only been 2 weeks, and now we see this tale of two cities in these earning reports and evidencing what we talked about.
So it had to be the case. If you are discounting 70, 80% because you are in a share battle with someone that we know now was Microsoft, that necessarily has to impact your ROICs. And that's what we call the warring factions. And the warring factions, in this case, in this battle for the core winners of the AI race in terms of service providers is between no other than Amazon, Microsoft, Google, and Oracle. And these four formidable behemoths are obsessed, all of them, with scale. And they know that the winner is going to be the one that gains the share war. And this is the reason why Microsoft is doubling down, is saying we're going to be spending 120 billion in capex, increasing the 90 billion that they spent in the last year. And Amazon will not have an alternative than to do that the same as Google and Oracle. So the only winners are going to be, again, as we mentioned in our prior episode, the arms dealers.
That's right. You start thinking what Amazon's competitive response has to be on this earnings season. It's discount more, gain back that lost share. And that precipitates Microsoft to go out and also fight it out. And the shareholders are going to be the worst for it, because this capex is being spent with ever decreasing returns, to the point where returns will be negative, because you're going to have huge depreciation that's going to bring down your earnings. At some point, you'll start bleeding free cash flow, and that's when you get into real trouble.
Quarter on quarter, Microsoft's D&A went from 8 to 11 billion. And I went ahead and did the math as to what's the NTM free cash flow is going to be, and calculated based on the current return on marginal invested capital, assuming that they are going to maintain, which is highly doubtful for what you just said, at 36%, and Microsoft is trading at 55 times cash. So if any hiccup were to happen in the growth trajectory, if any hiccup were to happen in the economy, if any hiccup were to happen in the obsolescence of these chips that are rapidly becoming not as attractive for the trainers and the inference, then those valuations can look very, very high very soon.
And now you're seeing Elon Musk buying the next generation of chips from NVIDIA for XAI. So it's a question of when these H100s become obsolete, and that's going to be interesting.
Yeah. Now, we don't have to do anything there, because what everybody buying chips is doing is using a lot of energy. And the rush to build generation capacity is such that there are no enough gas turbines to go around. And look at what's going on with the headlines. It's rush for US gas plants drives up cost, of course, and lead times. So there's going to be a very strong demand for anything that has to do with electricity generation.
Yeah, these nat gas fed turbines are in short supply. Lead times are getting longer, and that's just the fact of life in the wonderful world of commodities.
Yes.
I've been in it.
And this is where our expand energy and our range resources are going to thrive.
EQT,
and at the same time, and
EQT, we discussed in episode 1.
Yes, and this is one of the things that you need to thank Mr. Market, because at the same time, all the cards are set for this wave of natural gas demand. You see headlines such as these ones, that European gas is declining, but in the US, look at what's going on with the prices. The prices of Mid-Atlantic power auction, this is per megawatt day, went from $28 in 24-25 to $270, and they're expected to go to $330 in 2026-27. So what do we think is going to happen with natural gas prices?
It's only one way. It's going to have to, the pressure is going to be on the upside.
In the context of the regulators alerting us that we're having more and more brownouts and blackouts because of this heavy load posed on a very old grid by all these new data centers that are voracious in their appetite for energy.
That's right. It's outdated technology for the most part. So we know there's going to have to be a change, and what we're going to be discussing is probably maybe a solution to an outdated grid.
It's almost inescapable. global natural gas production dropped in May, which I find incredible. And then along the same lines of our thesis 4, we've been discussing this in our WhatsApp channel, and as to how thesis 4, which is essentially the era of fiscal dominance and financial repression and YCC or yield curve control. Trump signed the first step, which is the stable coin bill, and later he signed the Genius Act, and all these things are going in the same direction.
Yeah, they're going to increase demand for treasury bills and yield curve control and Operation Twist. These are all fancy names for what is going to eventually happen, which is the government is going to suppress interest rates.
Absolutely right. They need to suppress interest rate the same way we did in 1948 through 1956, or the same way we did in the 70s when the ratio of debt to GDP came too high. And the only way to go through that transition is through this process. And it's all over. And this is also something that eventually is going to be one of the catalysts of valuations coming back to Earth.
That's right.
And in that context, who is going to benefit? The beneficiaries of this interest rate, the repression, which essentially translates into negative real interest rates, which is what the government needs to afford the 130 ratio of debt to GDP, is players such as QXO, is construction, building materials, is small caps that are interest rate sensitive. And this is something that is also going to benefit them when we talk about price for perfection. People say tariffs loom. This is Wall Street not yet understanding, and this is again goes to our theme 4 and 6. This is Wall Street not understanding how tariffs are going to play out, right?
That's right.
So essentially, these tariffs are creating profit pools that didn't exist before. They're relatively insignificant for the general price level, but they are very significant for the beneficiaries of the tariffs.
Yep, that's right. And we've been talking on the WhatsApp channel about a few of these names, mostly in the automotive sector and auto parts sector, where companies have doubled in value since in the last few months.
Exactly right. And who are some of the greatest beneficiaries of low rates? Is small caps. And who are in small caps? In small caps is essentially you're going to find a lot of healthcare and a lot of biotech who's being destroyed in the last few years. Those are all going to be beneficiaries. And who's also going to be beneficiaries, as you just mentioned, the automakers, the OEMs. But again, we don't have to play the warring factions. We can play the arms dealers, and we're going to be discussing about significant opportunities here. But the interesting thing to me is that when the tariffs on autos were announced, and you and I were on the phone discussing this, the GM stock price went from 53, if I recall correctly, to 44, 45. And you and I were like scratching our heads because how come this can be negative for GM?
Yeah, that's right.
Or Ford?
Yeah. These are companies that are going to benefit. You're taking competition, you're pricing competition out, and that's just going to accrue. That just means that more share is going to accrue to these local producers who are going to have an advantage.
And we put all the math in the WhatsApp channel as to what extent GM is going to be a beneficiary. And it's not going to be the largest beneficiary. But what people miss is that GM has only 13% margin. They're going to have 15% pricing power, and their costs are going to be largely unaffected because most of their parts come from Mexico or Canada, and those are exempt from tariffs because of the USMCA. And on the parts are coming from overseas, they're getting a rebate. So they're going to be huge beneficiaries. Imagine if they weren't beneficiaries, the CEOs would be crying foul from the top of the highest mountain. And instead, look at what we have.
Yep, that's right.
So essentially, Oliveras is singing the praises of the administration because she knows perfectly well that these are favorable developments for the automakers.
That's right.
And who else? In the supply chain, our friends in the steel industry. Cleveland Cliffs, I think, is one of my favorite ways to play this because of the incredibly high operating leverage they have, the incredible commitment the administration has on making sure that these guys are successful and create jobs, and the fact that the steel industry has specific tariffs protecting them.
One of our favorite ways to play this, and gosh, I remember writing puts at $7.50 before Liberation Day.
And then you mentioned it earlier, the fact that the market is frothy, the fact that the market is expensive doesn't mean that there are no opportunities. There are all the opportunities above, and then there are the incredible opportunities in small cap value that we touched on thesis 5 and we discussed in our prior episode. And there are many ways to play this. We like China a lot, and we like Alibaba. Alibaba is a fantastic company, is a beneficiary of the AI boom because they became essentially one of the sponsors of the AI industry in China. Every time there is a startup in China that needs server capacity, Alibaba is the one providing the capacity, but these cash-strapped companies pay Alibaba with equity. So essentially, Alibaba became the owner of the entire AI ecosystem in China. They're cheap. Of course, they have the e-commerce business, and on top of that, they're going to ride this massive consumption boom the Chinese need to keep afloat and defend their economy from the Trump tariffs.
That's right. There's an economist that I followed for a long time called Michael Pettis, who's pretty active on X. He's a professor in Beijing, and he's been calling for a long time for the domestic consumption-led boom rather than continuing to play the infrastructure funding game that was sort of the first stage of development in China, sort of exports and capital investment. And he's been, for the last decade, he's been calling for retooling the economy to focus more on domestic consumption. And when it does eventually come, that Alibaba is going to be a great beneficiary of it.
Mm-hmm. Again, thesis 6, there are huge opportunities in small caps that are not exposed to tariffs. We've been pounding the table for a few, and now we're seeing, everybody and their friends in Wall Street raising targets on companies such as Etsy. Here you have UBS and Raymond James, and there you go. Many opportunities under the surface without getting exposed to the frothy areas of the market that we're discussing, and that are going to provide significant better returns than just staying blindly passive investing. All right, Paul, before we dive into the numbers, let's set the stage. We've been tracking these 6 mega trends that we think are going to shape the next decade, where one theme keeps rising above the rest.
Yeah, no question. It's the material layers of the solar ecosystem. Not the panels, not the policy, but the underlying materials, the silver, copper, lithium, that are quietly enabling the revolution.
And it's not just about supply chains, right? It's about scalability. And we were touching about the old grid and the need for a disruption in the space to satisfy these energy needs of the technium. And for the first time in history, we have the opportunity to build an energy system that doesn't rely on extraction, combustion, geopolitical choke points, massive pipelines, distribution, high voltage lines, etc.
Yeah, exactly. We're going from the era of digging things up to the era of manufacturing abundance. And solar is the foundation. For every trend that's coming, AI data centers, transport, it's all going to be sitting atop of the solar foundation.
So when we think in terms of solar as winning, we're not talking about subsidies, or we're talking about Green New Deal. We're not talking about ESG mandates. We are talking about fundamentals. We're talking about physics, economics, and deployment speed. This isn't a policy story. It's a fundamental story.
Yeah, and the plot twist, it's accelerating.
And before we jump into the meat and the core of the argument, I wanted us to take a step back and introduce a little bit of our sector view. And it's interesting that when you look at analyst forecast of earnings growth for Q3, who is at the top? At the top of all the sectors in the equity market is materials, and materials in Q3 is ahead of information technology, probably for many of the reasons about depreciation and amortization that we discussed earlier, and utilities and industrials that had an amazing run. And that's for Q3. For the full calendar year 2026, materials is the third sector with the highest earnings growth year on year, only behind energy that we already discussed, and we want to play through natural gas, and information technology. So I wanted to provide this general context before we get into our investment thesis around solar energy.
That's interesting.
So let's talk about the curve. So solar, as this chart shows, isn't growing linearly. It's on the convex portion of the S-curve adoption. Every year it gets faster. We're not just adding capacity; we're compounding it.
Yeah, there's one thing that human beings cannot do. It's not in our DNA, and it's understanding compounding rates. It's a quirk we have, and when we look at the adoption of solar, no energy has ever been adopted as quickly as solar has in just just a couple decades, really. It's faster than coal, faster than nuclear, faster than anything.
It's truly staggering. Just to think that we went from 1 gigawatt in 2000 to almost 2 terawatts in 2025 is truly remarkable.
Yeah, China alone added between 277 to 330 gigawatts in 2024. That's mind-boggling. It leapfrogs nuclear capacity added worldwide 50 times over.
So this is not a pipe dream. This is something that we're witnessing, that this is something that's been in motion for the good part of 2.5 decades. And I think this is what most people miss. This isn't a blip. For the past 50 years, solar capacity has grown roughly 10x every decade. That's not random. That's a trend. It's a trend shadowing the technium trend.
Yeah, a guy like me is old enough to remember when Jimmy Carter put solar panels on the roof of the White House. I remember seeing that on TV.
He was a visionary, I'm realizing now.
He certainly was. It's, history's going to treat him much more kindly than the other thing too is that, with fossil fuels, nuclear, and things like that, you have, even with nat gas, which we've discussed in episode 1, there are diminishing returns. There are losses in transmission. There are diminishing returns. And here in solar, we're still in sort of the steep end of the learning curve. And costs, as we keep going on this learning curve, costs are falling, materially so.
Yes. And what's driving that cost curve is the continuous manufacturing prowess and manufacturing at scale. So this is not about one breakthrough. This is almost about Moore's law applied to solar panels and solar panel electricity generation.
That's interesting you mentioned that. What do you call a force that's this powerful? Some might call it disruption. Others might call it inevitability. But you look at the fundamentals, cost, sustainability, distribution, and it starts to feel like this is a secular trend that's going to a destination point for humanity.
This is almost as if it was preordained. And there is this God's will argument. If you were God and you were to plan a civilization that is going to rely on electricity to drive abundance and prosperity and progress in general, what would you do? You would put a thermonuclear reactor in the sky, which in this case is the sun, at the center of the solar system, and then you would endow the Earth crust with all the critical minerals and materials and feedstock necessary to convert that light and heat into electrons. And incredibly enough, we are richly endowed with all the silicon and aluminum that we need to produce those wonderful solar panels. And then not only to produce those electrons, but we have plentiful of minerals that we can put into batteries to store that energy to produce 24/7 systems. So it's quite remarkable that we have naturally almost cheap, inexhaustible, decentralized energy source that is going to come from sunlight to solar panels to batteries to electrons in your home.
Yeah, it's the power of engineering. It brings me to a book called The Rational Optimist. I don't know if you've read it, but it's there's a whole section in that book, the whole section about how much energy was used to produce a certain amount of effort, be it to light a light bulb, etc. And you see the amount of energy just becomes lesser and lesser, and at a compounded rate over time. And you start to think, that human beings become better at doing things, at engineering, and that allows us to have greater and greater productivity. You mentioned Moore's Law, case in point as well. So we see it in a whole different sectors, and never underestimate the ability of human beings to figure things out. And I think that's what's happening now, is that with the speed at which we're transforming these technologies is getting faster and faster to our benefit.
Yes. And this manufacturing at scale and this human ingenuity is going to continue driving costs down as adoption increases in solar plus batteries. Now, even before that, look at these numbers. We were capable of producing solar generation at $4 a watt in 2010, which has come to $0.50 in China in 2025.
Its costs are getting cheap. From my previous career in mining, I can tell you that. I was speaking to an electrical engineer not too long ago, and he was telling me that now they are actually able to use renewables and battery systems in mines that are, out in the middle of nowhere and not connected to a grid, and they're actually sustainably operating with these renewable sources of energy, solar, wind.
Yes.
So this is something really fascinating, where we now have the ability to generate electricity, store it, and use it without sometimes being connected to a grid. And that's just a really powerful thing for humanity. It's going to make the southern hemisphere enabled to get electricity in a sustainable, cheap way. So I'm really optimistic about the future.
So in the energy transition, essentially, we went from hydro and coal, and we know that now natural gas is the marginal feedstock, and people are saying we're going to eventually land in nuclear. Today, you can build a 24/7 solar with storage system, which is essentially a microgrid, including solar panels and your battery, for $6 a watt. And that's versus $15 per watt in capital investment for nuclear. So it may be the case that we need to leapfrog nuclear if this situation becomes the generality across the world. And today, solar plus batteries is the cheapest capex investment per watt of generation and consumption in 60% of our markets.
You make a good point, and that question will probably be answered in the next decade, whether solar does leapfrog nuclear. Nuclear, of course, you've got the issues with waste and with fusion, and there are dangers related to it. Fukushima being in everyone's mind, or Chernobyl, if you will. So certainly, if we get there quickly, it's going to be the preferred way to generate electricity. Safest, most sustainable.
Yes.
For humanity.
And today we're generating solar and consuming solar via batteries in microgrids at a cost of 5 to 12 cents per kilowatt hour through a rooftop solar system. That's going to come down, further down, for all the reasons that we just discussed. And that compares with 17.5 of natural gas. It's going to be just a matter of how fast we can produce panels and batteries.
Yeah, it's natural gas is cheap at the wellhead, but everything related to transporting and generating power, that's what really adds a lot of cost. There's a lot of sort of toll bridges, if you will, on the way to the electricity meter. And I don't know if people understand what a powerful thing a microgrid is. It's just an awesome concept.
And it's essentially decentralized, is essentially autonomous. After you install a solar panel, it requires minimal maintenance, avoids all the transmission and grid cost. You were talking about natural gas, but think in terms after the electrons are generated, all the high voltage line, the transformers, the distribution lines, all of that is going to be completely obsolete. And you're going to have an ideal, reliable source of energy that is going to find a very thirsty consumer in the global south. This is going to be a wealth boost for the entire world.
Nothing is going to be more democratizing than the availability of energy, especially in the global south. This will democratize, this will bring wealth to people, and with wealth comes education and all those other good things that we need for good human development.
That's exactly right. And going back to the breakthroughs, this is going to continue. The cost is going to continue declining. The panel efficiency just between 2010 and 2025 went from 15 to 23%. This is going to become 30 and 35%. The battery costs are going to continue declining, 85% decline since 2010. This is remarkable. And automation is going to lower solar to $0.50 per watt globally. This is absolutely unbeatable in terms of energy generation of electricity. In that context, it's no surprise that China has put the full force of the governments and the subsidies and the 5-year plans into corralling, monopolizing the supply chain associated with the production of both solar panels and batteries. And they're winning, and they're winning by far. And the capacity they are adding every year is equivalent to all the US grid capacity. So this is something that is going to require the attention of the policymakers and the regulators, because the future is the technium, and whoever has the energy will have the capacity to activate the technium.
Well, this is kind of like the board game Risk, right? Here, by empowering and subsidizing in a lot of cases the development of this industry, this solar and battery industry in China, the Chinese are thinking long term, and they will clear the board eventually, because while we're fighting each other out because we don't want solar panels here or we don't want turbines here, and the grid is a bit of a mess, these guys have a very clear idea of what to do and how they're going to get there, and the U.S. needs to start being very, very careful, because and so do a lot of fossil fuel dependent countries as well, because this is going to be a game changer, and there are going to be tectonic shifts as a result.
And there is a pressing question, which is whether we're not already too late. This is a scale game, and right now, in none of the links of the entire supply chain, the Chinese control less than 90% of the manufacturing capacity. If you go in terms of lithium refinement, if you go in terms of battery manufacturing, electric vehicles batteries, solar panels, north of 90% share, and you're starting to see attempts by the trade policy in the US to protect the manufacturing of panels and the manufacturing of batteries. But the question is, how far behind are we from the Chinese and how long it's going to take for us to close that gap?
Yeah, that's a good question. I don't know the answer to that. There, I think our political system as a democracy um, is probably plays a little bit against us, and we're an autocratic system where you can get plans pushed through without much naysaying is probably an advantage. I'm not judging whether one's good or bad, but I'm saying it probably makes it
Yeah.
easier for the Chinese.
Now, this is all about identifying investment opportunities. This is what we are trying to accomplish here. And I think the case is very strong and very persuasive and compelling in that solar is going to play a central role in the energy endgame, that solar alone doesn't work. Solar requires 24/7 reliability, and that only comes with batteries. And batteries require lithium. So the question, one of our theses is that we want to play the lithium vector, but the skeptical may argue that why lithium? How do you know that there's not going to be other technologies with the potential to replace lithium? And this is where we need to land on why lithium has a long runway. It may be the case that in 15 years or in 20 years, there's a different battery technology. But in the next 5 to 10 years, there's no substitute. And even the cutting edge batteries, the solid state batteries, are going to use more, not less lithium. And these are some of the reasons as to why that's going to happen.
No, that's right. Um, lithium is probably I think the U.S. Geological Survey had probably one of the most abundant elements on Earth, but not necessarily in the concentrations you need to effectively mine it economically. Um, and as you mentioned, lithium has an edge, and we've got a good supply of it, cheap supply of it. So I don't think the other alternatives. You mentioned lead acid battery, which is a technology for the last century. Sodium ion, I understand, zinc air, aluminum batteries, things like that. Still, nobody's been able to make a dent in the efficiency of the lithium ion batteries. So, and like you said, it's probably going to be more intensely used. And there's plenty of it, so there's no reason to stop a more intensive use in the future.
Yes, and this is just simply physics again. This is natural selection and the survival of the fittest. And the three criteria are energy density, voltage, and lifespan, as you mentioned. Because of the abundance and the lifespan, there's no other substrate that is going to compete with it. On top of that, it produces energy at the best voltage range. And on top of that, it's the most energy dense of all the technologies available. And the best technologies at the cutting edge of the technological breakthroughs are solid state batteries that use lithium as a cathode and as an anode, which require more lithium per battery than the current existing technologies.
Oh, that's right.
This is sort of the result of all of the above. What you're seeing is an explosion in the demand of lithium ion batteries over the last 15 years that is expected to only accelerate through the 2030s. And the numbers again are exponential, and all the reasons that we stressed before, the fact that it's cheap, it's abundant, it's scalable, the manufacturing processes are very well known, and there is a Moore's law happening, are creating a confluence of factors for continued demand of lithium ion batteries into the
Yeah.
future.
This is Going back to something I mentioned earlier, just think about the doubling time in this chart. If you look at how long it takes, the demand to double, it's becoming fewer into years, right? That's what defines this exponential move, and it's hard for people to understand that because now we're not accustomed to nonlinear functions. So it's a pretty powerful chart when you look at it.
I don't think we can do one of those. I don't think we can do any of these conversations without quoting Charlie Munger. And what comes to mind now is that this is a Lollapalooza. And that's why this is a Lollapalooza of factors, and this is why we're seeing these charts, all potential exponential charts, that look like hockey sticks. And again, the notion here is that the energy based on hydrocarbons, extraction and transportation and refinement is very expensive. The energy associated with solar is free. It's just the sun coming out. The only thing we need is to be able to store it. So the solar, the trick is the battery. When the battery is combined with the solar panel, then you have this magic. And the magic tied with the microgrids and with the opportunity to completely unplug from the grid and do not require all those massive investments in grid infrastructure is what is making this very cheap from a capex standpoint and almost free from a maintenance and ongoing operating cost basis. And this is why we're so bullish on lithium. Lithium is the battery technology that is going to dominate over the next 10 years, which is a very long investment horizon for all practical purposes. And that's why we want to talk about two incredible assets in the lithium space that are going to provide for significant capital appreciation. Again, this is opinion, not advice, over the next 5, 10, 15 years.
Yeah, I was going to ask when we were going to get to the point where we see how we lever this awesome technology into great investments. And
yes,
this is the moment everyone's been waiting for.
This is the first one of two amazing companies that play in this space. And clearly, for many, many investors, a commodity is very unappealing and boring and dull and unattractive, except when it makes you a lot of money. And in a commodity space, you can, and you know this because you are the expert on mining here, the only way you're going to make money in a commodity space is if you are the lowest cost producer, or at least you are in the lowest first quartile. And Albemarle is a leading global lithium producer, which is incredibly well positioned to capture this opportunity. It has production costs in the $4 to $5 per kilo, and this is based on the fact that their mines in Chile are salt brine operations. This is essentially the only thing they have to do is pump water out of the aquifers, let it dry, and extract the lithium, and that is going to improve when they launch, and they are already in trial phases, the DLE, which is a faster way to extract lithium from water in 2028 and onwards. So they own these early stage lithium resources in the US and Argentina, so they're incredibly well positioned, and they have the lowest cost lithium sources globally in Chile, and their cost advantages, as you can see on the right hand chart, are unparalleled, only similar to the one that Paul is going to be talking about. Why do we think this is attractive? Because it's dislocated. The lithium market went ballistic during the COVID and crashed after that due to overcapacity in the industry. Right now, prices are stabilizing and recovering. We know that the marginal cost producer is at about $20,000 to $25,000 per metric ton. And at those prices, Albemarle has such operating leverage that it's going to be generating about $2 billion in EBITDA. This is a company that traded at 25 times EBITDA in 2020 and traded at 33 times in 2021. So assuming that they're going to be trading at 15, that gives us a share price of $155 per share, which is 2.3x the prevailing prices at the close today. And to do this, they only need to accomplish these EBITDA numbers, they only need to grow their production at a 10-15% per annum, which is easily achievable for Albemarle. And with that,
Yep. Go to my favorite company, which is SQM. It's Sociedad Química de Chile, also known as Sokimich. And it's the largest and lowest cost producer of lithium in the world. The source of lithium is primarily sort of these underground salt brine lakes that you see in places like Argentina, Chile. Bolivia has the largest one in the world, which is the Uyuni Salar. And SQM is located in the Atacama Salar, which is the lowest cost area in the world. They can produce at $4 to $6 per kilo until 2060. This is a company that's a lithium giant. However, probably about 40% of its production is iodine, and the rest is some, I think it's plant nutrients, so fertilizers, if you will, that are byproducts of mining brine. And we believe that this is an industry that's going to be growing exponentially. To make this a really simple idea, just think about volume of demand for the products these two companies produce going higher and higher. They've got costs that are going to be increasing at a much lower rate than the price is going to increase. So that's what you call operating leverage, right? And that turns out to be sort of abnormal profits to the shareholder over a commodity cycle. And we don't think that this is just a commodity cycle. In the case of lithium, we think this is a secular trend. So this operating leverage is going to become bigger and bigger as we go over time, because the demand and the other sources of supply tend to be things like hard rock mining, which is much more costly. And let's say we're wrong. Let's say that it takes a lot more time for lithium prices to go up. Well, the fact that we've got the lowest cost producers as investment sort of insulates us, because probably 90% of the industry will go bankrupt before we go bankrupt. So it's,
as I learned from our Mexican friends in business school, they're going to be taken in stretchers by the clowns.
That's right. And I thought I've got 30 years in resources, from trading to mining, and you always bet on the lowest cost producer. And if you can buy those businesses at good prices when they're at a cycle trough, which we believe we're starting to emerge from in the case of lithium, that basically is the opportunity.
I think it's an incredible entry point at the market. Mr. Market is gifting us. It's clearly in the depressive phase of its manic depressive cycle regarding these two assets. I think from Brad Jacobs we learned you need to get the trend right, and we already explained why the trend is the right one. And the way to play the trend is, again, not competing on who's going to be the battery producer or the solar panel producer, or who's going to be the array installed in a solar farm, or who is going to be the installer. Is all of those systems, all those energy storage systems are going to require lithium. Lithium is going to be in an incredibly high demand, and the prices necessarily need to go up because the marginal cost producer is at $20,000, $25,000. And at those prices, these two players, because, as you rightly pointed out, are the low cost producers, are going to be minting money. Again, this is opinion, not advice. Read the disclaimer. But Paul and I are super excited about this opportunity.
Yeah, I think this is going to be one of those calls that that weathers very, very well for us. And as we mentioned in episode 1, our wheelhouse is trying to look for investments that have asymmetric returns compared to the risk that we take. And we believe in keeping with that oath. We think this fits very well with that logic and our investment process.
Wow, what a journey!
It's
from terawatt hours to Type 1 civilizations. This has been nothing short of a fascinating tour de force, my friend.
Yeah, I think it's pretty mind-blowing stuff, but I hope you guys liked it. If you did, hit the subscribe button and turn on your notifications. We're just getting started. This is just the second episode, and we've got a long way to go.
New episodes drop about every 2 weeks. We're going to continue diving deep into the tech, the policy, and the investment opportunities shaping these times.
Thank you, and have a great weekend.
Over and out. Take care, my friends.